Hello, my name is John Mattis, and in this video we will be discussing Schedules A and E. Schedule A deals with itemized deductions on Form 1040 of your United States federal income tax return, and Schedule E deals with supplemental income and loss. Now that deals with rental real estate and royalties and etc. For this example, we will be dealing with rental real estate of a woman who has rental secondary home property. Now we will implement Schedule E and A at the end into our Form 1040 to understand why they are important to calculate, especially with an example such as Schedule E. So, for this example, we have Anna Gastayer. Rented her second home for 30 days, used it personally for 20 days, and left it vacant for 315 days. She had the following income and expenses related to the second home. Rent income, $7,000. Real estate taxes, $2,500. Interest on mortgage, $9,000. Utilities, $2,400. Repairs, $1,000. Roof replacement, which is a capital expenditure, this is important, of $12,000. And depreciation, full year, $7,500. The reason all of these are extremely important is because there are certain limitations on things such as depreciation. So in tax, we will see there are limits on just about anything you can think of. So let's look at the standard deduction. For 2021, we have Form 1040, as we said. On line 12A, as you can see right here, you are able to choose the standard deduction or itemized deductions from Schedule A, which we will be discussing, to take from your AGI. Now, this may seem a bit obvious, but for those who are watching this video and may not know, you're going to want to choose the larger between your standard deduction and your itemized deduction because it is a deduction and you want to save money. Anna, as we saw, was single, so her filing status is going to be single, and her 2021 standard deduction is $12,550. So, if her itemized deductions from Schedule A, this schedule, equal above $12,550, she will enter that number into line 12A of her Form 1040. So, the reason this example is going to be helpful is because there are many Americans who own secondary homes that they rent, and they can itemize the deductions from these homes. Every American who files a tax return can itemize deductions. This one is specific to those who have a secondary rental home. So, first we begin with rental income, the $7,000. Now, the two approaches for itemizing deductions under a rental property are the courts approach, as we can see here, and the IRS approach, which is all of this work above. Now, the threshold for personal use, which is important to understand to begin, is 14 days. So, you either have 14 days or 10% of the rental days. So for Anna, she rented her home for 30 days. 10% would be 3 days. She's going to take the 14 days. So the 14 rental days apply here. First, we begin with the rent income, which we see on here, of $7,000. $7,000 here, and you deduct the taxes and interest. Now, this is an interesting aspect of this. For this issue, for taxes and interest in the IRS method, you want to multiply the taxes 30 days, which is how long she rented it, divided by 50 days, which is the amount of time she rented it plus her personal use, and multiply that by $2,500, the real estate taxes. Now you want to do the exact same thing with interest. You want to do 30 divided by... Upon deducting your taxes and interest from your rental income, you will find the remainder to apply to rental operating expenses and depreciation, which is $100. Next, you want to deduct the utilities and the maintenance using a similar calculation from taxes and interest, 30 divided by 50 times 3,400. The 3,400 comes from the utilities of 2,400 plus the maintenance, which is listed as repairs, of 1,000. 30 divided by 50 times 3,400 is 2040. But it is limited to the remainder to apply. So you can only deduct 100 from the 2040. This leaves you with a balance of 0. So under the IRS approach, you're left with a balance of 0 after the taxes, interest, utilities, and maintenance deducted from rental income. Now, normally you would want to deduct depreciation, which would use the same format, 30 divided by 50 times 7,500 full year depreciation. And depreciation is also limited to the balance. However, here the balance is 0, so her net rental income is going to come out to 0 under the IRS approach. Next, we want to look at the courts approach. How does the courts approach differ? As we can see, bottom line up front, it does not differ significantly. The calculation does, though. This is important because you're not going to have the same numbers in your example, likely, or the way you run your business. So we have rental income, $7,000 again, and this is where the calculation differs. Specifically under taxes and interest, we can see you have the 30 days from her rental home days, and you divide it by 365 instead of the 50. You don't want to deduct, or you do not want to divide it by 30 plus 50, which is the personal use plus the rental days. You want to deduct it by the full year. So taxes and interest are deducted 30 divided by 365 times the value. So taxes 30 divided by 65 times 2,500 is 205. Interest 30 divided by 365 times 9,000 is 740. Deduct that from 7,000 and you are going to find a remainder to apply of $6,054. For the court's approach, this is where it's interesting. As we can see, the taxes and interest differ from the calculation of the IRS taxes and interest, but the utilities and repairs do not. So they're going to be the same, 1,440 and 600, but they're going to differ because up here in the IRS approach, they were limited to that balance. Down here, the balance was much higher, so they're not going to be limited. So we're going to end with, after utilities and repairs, a balance of $4,015. This is where depreciation calculation comes in. For this, we have a depreciation calculation of 30 divided by 50, similar calculation from utilities and repairs, times 7,500, depreciation full year, to get $4,500. Again, depreciation, similar to utilities and maintenance up here, is limited. In tax, you're going to see a lot of limitations. Here, it's limited to $40.15. Your net rent income is $0. Now, this is where we're going to begin our Schedule A. As we can see, we have Schedule 5A, line 5 on Schedule A. We skipped the medical and dental expenses because Anna had none. It's very, very important to fill in your name and your social security number so your entire tax is not voided, your schedule. For 5A, we have state and local income taxes, $7,500. That's going to be her rental income. Next, we have state and local real estate taxes, $47.95. We can see we got the $47.95 from. Once we have completed Anna's IRS versus courts work, we're going to want to look at the Schedule E, which is supplemental income and loss. So this is from rental, real estate, royalties, partnerships, S corporations, etc. Now Anna has the rental real estate, so we want to write her name, her social security number, and we want to look at, did you make any payments in 2021? She did not. That would require her to file Form 1099, and she will not file Form 1099. First, we want to write her physical address. Next, we want to list how many types of property does she have. She has one. Then we want to incorporate all of the work we just did. She had 30 fair rental days, 20 personal use days on that property. The rents, so she is a single family residence, as was listed in the example. She has $7,000 in rents received, and as we saw in this work right here, so she has $740 in mortgage interest paid because we are going to use the courts approach as the work goes further, and we just decided that it is better because the carryover depreciation is less here, so it's more in IRS, it's less in courts method, and the mortgage interest is much higher, $8,260, than it is $3,600 in the IRS method, as well as real estate taxes, $2,290 versus $1,000. So they clearly both come out to zero, but it's important that we want to know we use the courts approach because the mortgage interest, real estate taxes are much higher here than in courts, and these are going to be classified as itemized deductions on Schedule A. But for Schedule E, we want to use this info to input it in. So we have $740 for mortgage interest, which we get from interest, $740 under the courts approach, since we're using that. Then we just use each of these that we have from the work. $600 for repairs, $600 for repairs. Now we have taxes of $205, taxes of $205. $1,440 of utilities. $1,440, check that, correct. $40.15 of depreciation expense or depletion. We have depreciation, calculated $40.15. That's going to give us total expenses of $7,000. Now you want to subtract line 20 from line 3. Line 20 is total expenses. Line 3 is rents received. 7,000 from 7,000. That's going to give you a 0. Skip 22 because she does not have a form 8582. 23A, total of all amounts reported on line 3 for all rental properties. Line 3, she had $7,000 of rent received. $7,000. This is a very nice schedule, as is every tax schedule, because it gives you line by line instruction within. So here we can just move on. $740 for 23C, that's how much was on line 12. Line 18 was the depreciation line, which is $40.15. And the total amounts for line 20, which was total expenses, is $7,000. So as we can see, that's going to be our Schedule E. We needed to fill that out for all of the work we did, and now we have 0. So we can move into our Schedule A. This is our Schedule A completed form. $7,500 of rents received, put in her name. There were no medical and dental expenses. These were the taxes she paid. This is on itemized deductions, very important because that's between the standard and itemized again. $7,500, $47.95 of state and local real estate taxes. Add lines 5A through 5C, get that, $12,294. Enter the smaller of line 5D or 10 grand, so 10 grand is smaller than $12,294, and we end up with 10 grand on line 7. The interest she paid, which we got from Schedule E, home mortgage interest, $18,260 here because there was nothing else from A through 8A through E or line 9 that applied. She had $1,000 gifts of charity. Now this information is coming from the example that we have here. That's where we're getting all of this information. It's important to notice charitable contributions of $1,000, state sales tax $750, etc. I'll give you a second to look at that. So that's where we're getting the $1,000, the home mortgage interest. So we have $10,000 for line 7 under the taxes you paid section, $18,260 under the interest she paid section, and $1,000 under the gifts to charity. She had no casualty and theft losses and no other itemized deductions. So Anna's total itemized deductions come out to $29,260. Now remember from earlier, we discussed you can choose for your Form 1040, line 12A, standard or itemized deductions. We're going to put in her itemized deductions of $29,260 because as a single taxpayer in 2021, Anna's standard deduction would only be $12,250, which is about 17 grand less than her itemized deductions. That's a major deduction savings. So this example discussed the importance of understanding how to schedule itemized deductions and your Schedule E, which is supplemental income and loss based off of rental real estate for this example specifically. Itemized deductions apply to every single taxpayer. So this is extremely important to read, understand. There are line-by-line steps. And now we understand that for Anna Gasser, she wants to itemize her deductions and put it on Form 1040. Everyone should be well versed if they would like to fill out these forms, if they want to do their taxes by themselves, because as we can see, this is a minimal aspect of the entire 1040. It's one line. So please, if you're going to file your own taxes, ensure that you are doing it correctly. Thank you.